A very warm welcome to everyone, wherever you're joining us from across the world. Thank you for tuning in to this live event hosted by the World Bank's Multilateral Investment Guarantee Agency, MIGA. I'm Esther Awuni, business anchor at CNBC Africa and your MC and moderator for today. Thank you for joining us. Today, we'll be unpacking the theme, Driving Foreign Direct Investment to Africa, the first in an annual series. In the next 60 minutes, we'll showcase investment opportunities in Africa and share new thinking and discussions on FDI among a cross-section of experts, including investors, policymakers, and economists. And we'd love for you, our online viewers, to be a part of today's conversation. So please go ahead and post your questions, reactions, and engage with the panelists and speakers from the platform you're watching this event from. And please also share with the event hashtag FDI Africa. Once again, I welcome you all. Now, to help us kick things off, please welcome Mr. Hiroshi Matano, Executive Vice President, MIGA, with some opening remarks. Over to you, Hiroshi.
Thank you, Esther. I'm pleased to be kicking off what I hope will be the first in annual event series on FDI. While we always look to innovate and introduce new product lines, such as credit enhancement and support for trade finance, FDI lies at the heart of what we do. We're the agency within the World Bank Group mandated explicitly with bringing in FDI to developing countries. And indeed, we rose to the challenge in fiscal year 21 by issuing $5.2 billion in insurance coverage for projects across the world. However, this event is intended to be a discussion and spark conversation, not just showcasing the work we're doing. This is why we have asked James Zhang of UNTAG, who is chief editor of the World Investment Report, to set the big picture stage for us. In the spirit of conversation and problem solving, we have also asked experts and practitioners, including Honorable Minister Amadou Hott, who works every day on the challenge of bringing in FDI to Africa, to share their thoughts on what the challenges and opportunities are. We focused in Africa this year because it had been hit particularly severely as a result of COVID. FDI flow to sub-Saharan Africa decreases in 2020 by 12% to $30 billion. And greenfield project announcements key to industrialization process in the region dropped by 62% to $29 billion, while international project finance plummeted by 74% to $32 billion. These are big challenges, and how they can be addressed will be discussed further over the coming hour. And I look forward to an enriching conversation. Before closing, let me add in that in addition to this public annual event, MIGA also aims to host FDI dialogues in several African countries over the next few months to ensure that this conversation goes forward. Assuming safe travel is practical, MIGA management and staff look forward to meeting with investors and policymakers to further discuss the pressing issues. With that, let me invite President Malpass to say a few words.
I'm very pleased to welcome you all today to discuss a topic that is a critical part of driving sustainable economic recovery in Africa. That is mobilizing private investment and FDI into the region. MIGA was established 33 years ago because the World Bank governors at the time realized that concerted action was needed to increase capital flows to developing countries without unduly increasing their indebtedness. They built a foundational organization, MIGA, whose purpose is to drive FDI into developing countries through investment guarantees. Though that was a different era, we find ourselves faced with new compounding challenges: reversals in development, rising debt, a fragile global economy, and the climate crisis. These challenging times, however, also offer us a profound opportunity. For Africa, FDI can help drive economic recovery, create jobs, generate taxes, open up participation in global value chains, and be a conduit for knowledge sharing. It has a great potential to bring much needed investments in climate infrastructure and resiliency to Africa. The COVID pandemic has had a big impact on FDI. Flows into emerging markets fell 8% in 2020 and 16% to Africa. However, signs that the continent will rebound as a destination for FDI are emerging, and foreign investors are seeing green opportunities as well. Renewable energy investments into Africa actually rose by 28% in 2020. Globally, the rise in sustainability-focused investments has been rapid. In 2020, the value of sustainably themed investment products was $3.2 trillion, up more than 80% from 2019. However, the vast majority of this is directed to developed markets, and it's our collective responsibility to channel more of this funding to developing countries and Africa in particular. Looking ahead, there are concrete actions that can be taken to best leverage FDI going forward that I'd like to put on the table. First, it's important to protect existing FDI flows and preserve supply chains that connect foreign and domestic suppliers. Policymakers need to review investment policy and promotion strategies to test which ones have proven resilient and can support the early stages of the recovery. Second, policymakers need to aim for returning to pre-pandemic levels of FDI by focusing on emerging competitive sectors. Analysis of sector dynamics and investor consultations are key to confirm investment competitiveness of these sectors. This will enable more targeted investor outreach and promotion of strategies that can position countries as investment destinations. And third, investment policy reform should improve the value propositions in these identified priority sectors. Countries should focus not only on attracting more FDI, but strengthening its impact so that it is development-oriented and facilitates reallocation of resources toward long-run economic transformation, job creation, and inclusion. This will depend heavily on enabling the business environment. Solid actions can lay the groundwork for improving overall business climate and investment conditions to attract sustainable FDI. The World Bank Group stands ready to work with our clients on these critical issues. Our MIGA arm is well equipped to work with private investors who want to be part of this sustainable recovery. I hope these discussions will help untangle some of the challenges in driving FDI to developing countries and specifically to Africa. I hope we can collectively chart a concrete path of channeling investment into the most impactful projects that deliver returns on human capital, broad-based growth, and sustainability. Wishing you all a very fruitful discussion. Thanks.
The significant drop in FDI to Africa since 2020, FDI inflows remain the continent's key to sustainable growth. Well, joining me now to give us a better picture of the state of and trends in FDI flows in developing countries and an outlook for the African continent is Mr. James Zan, Senior Director of Investment and Enterprise at the United Nations Conference on Trade and Development, UNCTAD. Well, thank you so much, James, for taking the time out to join us today. Let's just dive right in. What is the current state of FDI in Africa?
Thank you, Esther. I think for the current state, I would say that FDI in Africa was hit hard, but more resilient with a quick rebound. FDI in Africa was hit hard by the triple shocks caused by the pandemic, supply, demand, and policy, but the decline in inflows was much less than the world average. In 2020, FDI to Africa declined by 16% to $40 billion. Most countries and regions within the continent was affected. FDI inflows to North Africa contracted by 25% to $10 billion, with major declines in most countries, such as Egypt, Algeria, Sudan, and Tunisia. FDI inflows to Sub-Saharan Africa decreased by 12% to $30 billion, with large declines in Ghana and South Africa. But nevertheless, FDI flows to Africa demonstrated more resilient compared with the rest of the world. Global FDI declined by 35% last year, with much more decline in developed economies, transition economies, and Latin America. But for the current state, I'm talking about the first half of this year, FDI flows to Africa rebounded with 16% increase, reaching an estimated $23 billion. For Sub-Saharan Africa, it saw 22% rise, with FDI reaching an estimated $18 billion, and flows rose strongly in Nigeria, Mozambique, Ethiopia, and South Africa. FDI remained flat in north of Africa, while flows to Egypt registered a very minor decline. They rose in Morocco and Tunisia. So please note that the relatively positive picture masks the divergence in sectors, types of investment, and geographical distribution.
Well, positive indeed. But are there countries and sectors where FDI levels have remained steady or which haven't been as affected by the pandemic, and why so?
Yes, Esther. In some countries, FDI flows remained steady or increased slightly in 2020. For example, flows to Morocco remained stable at $1.8 trillion. Morocco's FDI profile was relatively diversified, with an established presence of some major multinational companies in manufacturing sectors, including automotive, aerospace, and textiles. Inflows to Nigeria increased slightly to $2.4 billion, and to Senegal, FDI was higher, and in fact, it increased by 39% in 2020. Central Africa, as a sub-region, registered an increase of FDI with inflows of $9.2 billion, and this increase in inflows, in particular, in the Republic of Congo.
Okay, but what do you observe in? Oh, go ahead. Sorry to interrupt you.
Yes.
There. Go ahead.
Sector-wise, the natural resources sector was hit hard in 2020, but had rapid recovery in the first half of this year. And the new investment growth sectors was disrupted in 2020, but growing, including logistics, financial services, consumer services, and renewable energies. What is worrisome is the SDG, Sustainable Development Goal sectors. It was seriously impacted, and it will take longer time to recover. So this includes transportation, water and sanitary, food and agriculture, health and education. So the immediate challenge is to minimize the number of lost years in terms of progress made towards SDG goals. So the main concern in Africa is that the pandemic could wipe out the development gains achieved over the last decade.
Hopefully that won't be the case. But what do you observe in terms of FDI flows to more vulnerable countries or those affected by fragility and conflict?
Yeah, for this vulnerable economies and low incomes, I would say it's noteworthy that FDI inflows to the 33 African least developed countries increased by 7% to $14 billion in the mid of the pandemic. As a result, that African LDCs performed better than Africa as a whole. As I mentioned, that for FDI flows in Africa as a whole declined by 16%. So the inflows exceed 1 billion in 5 African least developed countries, and 500 million in another 5. Ethiopia remained the largest African low-income country's recipient for FDI. In Mozambique, inflows grew by 6%, and in Democratic Republic of Congo, investment increased by 11%. So in Tanzania, investment flows grew by 2%. Uganda fell by 35%. In Sudan also decreased by, and it's decreased by 13%. So that's roughly the picture of vulnerable and low-income economies in
Okay, now,
Africa.
James, what is your outlook for FDI for the continent? Obviously, we're hoping that the numbers do pick up going forward. We know that there's still issues of debt that many African countries, the looming debt crisis, we're told, on the continent. Of course, multilateral agencies trying to aid African countries to ensure that they're not buried under all that debt. But what is your outlook for FDI for the continent?
Yep. As the short-term and longer-term. The short-term prospects, I would see a rapid rebound, but the full recovery takes a longer time with uncertainty. So FDI in Africa expected to increase in 2021. That's what we are witnessing. But a full FDI recovery will take place towards perhaps the second half of 2022. Amid a slow rollout of vaccines and the emergence of the new COVID strains, such as Delta and Omicron, a significant downside risks persist for FDI in Africa, and the prospects for an immediate full recovery are uncertain. Specifically, we see that similar to the global level, growing investor confidence in Africa is mostly in infrastructure, boosted by favorable long-term financing conditions, recovery stimulus packages, and development assistance related investment programs, and international project finance deals, in fact, are up significantly in value. And we also see that it's largely large deals in some power sectors. Now, in contrast, investors' confidence in Africa in industry and global value chain remains uncertain. Greenfield investment projects announcement continued their downward path. That's about 30% in value and 25% in number of greenfield projects for the first 3 quarters of this year. So that's the kind of indicator for the immediate future of FDI flows to Africa. The recovery of investment flows to sustainable development goal related sectors in Africa, which suffered significantly during the pandemic with almost a double-digit declines across all SDG sectors, and they will remain fragile. The combined number of announced greenfield investment and projects finance deals fell by 32% in this SDG sectors, that's education, water, sanitary, and what I mentioned earlier. Longer-term prospects in Africa for FDI, I would say, positive with great potential. So new opportunities due to global value chain restructuring, which is going to happen, intensified business-related international assistance in Africa by major countries, the approval of the key mega projects, the African Continental Free Trade Area Agreement, and its forthcoming Sustainable Investment Protocol could lead to investment picking up greater momentum beyond 2022. So Africa is projected to grow by 4.6% in 2021 and average 4% up to 2025. All this will attract investment in the years to come.
Well, fingers crossed on that. Thank you so much, Zan, for talking to us today. Now we're moving quickly to our next segment.
Thank you to MIGA for inviting me.
Now we're moving quickly to our next segment where we go behind the scenes to get a good sense of the impact of FDI on the ground in African countries.
Good morning, good afternoon to everyone joining today. I would like to take you through a quick tour of MIGA in Africa and the role we play in driving foreign direct investment into the region. First, a quick overview of what MIGA does. MIGA's investment guarantees can support a variety of projects, ranging from pure private sector all the way to public sector projects procured by governments. We offer political risk insurance products to protect against transfer restriction and currency inconvertibility, expropriation, war and civil disturbance, and breach of contract risks. We also offer a credit enhancement product that protects against defaults of loans to eligible host governments. MIGA has been supporting investments in Africa since its inception over 30 years ago. Currently, Africa is the region with the largest outstanding gross exposure, representing nearly 30% of our total portfolio exposure. That's $6.5 billion in guarantees across 99 projects in 30 member countries across Africa. MIGA's impact has been significant. 11 million tons of CO2 equivalent avoided per year, 19,000 gigawatts of power generation, and 40,000 people employed. Now travel with me across the continent and take a closer look at some of our projects where MIGA has worked with investors to uncover the investment opportunity. Our first stop will be the Kasada Hospitality Project. This project spans 10 countries across Africa. Kasada, a hospitality-focused private equity fund, approached MIGA as it was considering building its portfolio of up to $1 billion into the hospitality industry across Africa. MIGA is providing total coverage of up to $271 million to Kasada and its subsidiaries. The first set of projects to be covered, a portfolio of 8 brownfield hotels acquired by Kasada and operated by Accor in Cameroon, Côte d'Ivoire, and Senegal. A trend we've been witnessing is a gravitation towards brownfield acquisitions versus greenfield projects in the post-COVID recovery. Greenfield project announcements, which reflect investor sentiment and future FDI trends, dropped by 62%, from $77 billion in 2019 to $29 billion in 2020. Greenfield investments are particularly difficult in the hospitality sector, where existing capacity remains above demand. For MIGA, the Kasada project was a great opportunity to support a brownfield investment that will preserve existing jobs and create new jobs directly and indirectly right away. As part of its $1 billion portfolio, Kasada will pursue 70% brownfield acquisitions and 30% greenfield developments. Kasada will prioritize projects that have started construction but have not been completed due to a lack of capital and/or other economic pressures. Now let's move to Burkina Faso to discuss some solar projects MIGA is supporting. Burkina Faso has one of the lowest electrification rates in the sub-Saharan African region, 20% as compared to 48% for the region overall. The country is striving to address its energy access challenges and enhance its energy security. To advance energy access in the country, MIGA recently issued over $5 million to French investor Green Yellow that will cover its investments into a 30-megawatt solar PV energy facility in Nagriongo. What makes this project unique? The plants are anticipated to be part of the first round of solar IPPs in Burkina Faso and will bring much-needed clean and affordable power to the country. Our next stops are in Central Africa, where MIGA has partnered with an innovative off-grid energy access company called Bbox. Bbox is a next-generation utility that offers off-grid energy solutions, including solar home systems, alongside equipment like lights, televisions, and refrigerators. Bbox is also using energy as an access point to other services, such as LPG cylinders and small gas burners for clean cooking. Last year, MIGA issued guarantees of up to $37 million to a fund managed by African Infrastructures Investment Managers, and almost $6 million in guarantees to the Facility for Energy Inclusion's Off-Grid Energy Access Fund for their investments into Bbox. We saw a unique opportunity to drive investments into the company's innovative business model, leveraging pay-as-you-go mobile money payments and their off-grid solutions. For our last destination, let's zoom out to 2 Pan-African financial sector projects. In 2020, MIGA supported 2 African banking groups, ABSA and First Rand, to boost lending in the region and increase bank resiliency amid the COVID-19 pandemic. For ABSA Group, MIGA issued almost $500 million in guarantees to help expand financing across 7 countries. Freed up capital would be focused on financing corporates and SMEs, as well as on projects with potential climate co-benefits. In addition, as part of the COVID-19 response program, MIGA issued guarantees to FirstRand to support its subsidiaries. The guarantees free up capital, which allows the subsidiaries to continue their operations and weather the pressures arising from the pandemic. Both ABSA and FirstRand projects are examples of MIGA projects where financial institutions have tapped into MIGA's capital optimization product to help boost lending during the COVID-19 pandemic. Now, this is where our journey ends today. And as you can see, from all corners across Africa, MIGA has been a valuable and trusted partner for investors who want to invest in an impactful project. MIGA products not only deliver more security to investors, but they also can help reboost foreign direct investment in a post-COVID future. Thank you and have a great day.
Le Covid a fortement affecté le taux d'occupation de nos hôtels, pas nos hôtels Ibis Dakar seulement, mais dans tous les hôtels du Sénégal, beaucoup d'hôtels sont restés fermés et même présentement ils ouvrent difficilement. Et pour l'instant, l'occupation n'est pas encore ce qu'on attendait par rapport à 2019. Donc on a des taux d'occupation qui sont un peu en dessous de 50% pour l'instant dans nos hôtels. Voilà, donc et tout ça c'est lié à l'impact Covid vraiment.
Le Covid vraiment a été un coup très dur pour tout le monde, pour le personnel et tout. On a dû arrêter nos activités, rester à la maison plus d'1 an. Donc ça n'a pas du tout été facile, les déplacements étaient limités. Donc c'était pas du tout facile, c'était très compliqué.
Voilà, pour ma vie professionnelle, donc on est resté à la maison. Comme nous toutes, on est partis, on est resté à la maison. Mais cela ne nous a pas empêché de recevoir nos salaires. On a continué à recevoir nos salaires. Mais pour la vie personnelle, donc mes enfants ont arrêté de travailler. Mon mari travaillait de temps en temps, mais les enfants ont arrêté l'école.
On a été vraiment impactés. À un moment donné, les hôtels étaient fermés. Les 3 hôtels, Novotel, Ibis et Pullman. Après, on a commencé par ouvrir le Pullman au mois de juin 2020. Après, c'est le Novotel et Ibis qui s'en ont suivis. Si vous voulez, à un moment donné, les frontières étaient fermées au niveau du Sénégal. Donc c'était très très compliqué. Il n'y avait presque pas d'hommes d'affaires, de séminaristes qui venaient. Et donc ça a changé vraiment. On a essayé de diversifier le produit en ciblant les locaux, en faisant des tarifs promotionnels pour les locaux, notamment des offres week-end, en diversifiant aussi des offres au niveau du restaurant, avec les brunchs à thème et des animations au niveau de la piscine, au niveau de la terrasse.
Si je reviens sur le rôle de Casada, bien sûr c'est surtout sur le côté investissement, remise à niveau des chambres, des espaces communs, en tout cas des équipements en quelque sorte, parce qu'il fallait vraiment beaucoup d'argent pour pouvoir réouvrir l'hôtel. Si j'ai bonne mémoire, on avait estimé les dégâts matériels à quelques 280 millions et quelques. Et donc Casada a intervenu bien sûr pour pouvoir financer une bonne partie de ces travaux pour que l'hôtel soit prêt à réouvrir et à accueillir de nouveau des clients. Donc là, c'est vraiment une bonne chose, un bon coup de main que Casada a donné pour que les hôtels puissent être là au niveau où ils sont présentement. Mais on n'a pas encore atteint le rythme sur lequel on était en 2019, donc ça reste beaucoup. Donc on attend beaucoup vraiment que la maladie disparaisse et que l'activité touristique puisse reprendre de la manière la plus belle.
Well, that was a behind-the-scenes look at the impact of foreign direct investment in developing countries. Now we're moving on now to our panel discussion for this event. Joining me for a conversation on driving FDI to Africa is Mr. Amadou Hott, the Honorable Minister of Economy, Planning and Cooperation, Senegal. Also joining us today is Cheryl Boss, CEO at ABSA International, David Damiba, Managing Partner and Chief Investment Officer, Casada Capital Management, also joins us today. Please welcome also Ethiopi's Tafara, Vice President and Chief Risk, Legal and Administrative Officer at MIGA. And last but not the least, Dermot Gill, Vice President for Equitable Growth, Finance and Institutions at the World Bank. Thank you all for joining us, taking the time out to join us today. A quick reminder to our audience to please post your questions to our panelists. There will be a live Q&A session after the conversation. Also remember to use the hashtag FDI Africa. Now let's get right to it. Let's begin this conversation by taking the perspective from governments. Honorable Minister Hott, could you first tell us how COVID-19 affected FDI flows to Senegal and how the country has handled the challenge?
Thank you very much, and thank you to MIGA for this opportunity and to CNBC for this opportunity. As we all know, the COVID has affected FDIs in Africa, especially in sub-Saharan Africa, down 12% to $30 billion. But in Senegal, we managed actually to increase FDIs thanks to the energy sector, in particular the investments in oil and gas. We have major oil and gas projects going on right now, was expected first oil production and gas production in 23. So the majors have been investing heavily, and therefore we managed to have a 39% increase to $1.5 billion. We saw really no investments on the tourism sector, no investments virtually on all sectors, no FDIs basically, but the government continued to invest during this period in various sectors, but also put in place a resilience, economic and social resilience program of about 7% of GDP that helped us actually avoid the recession. And we finished the year at 1.5% of growth in 2020. But in 21, we're seeing things picking up again, with growth expected at around 5% this year, and next year 5.5%. And we've taken some measures actually to make sure that we are attracting more FDIs in the short to medium terms.
All right, thank you, Honorable Minister. Now let's bring in the perspective of the private sector and investors. I would like to ask both Cheryl and David how your firms have navigated the pandemic within the continent, and how has the current situation changed your approach to supporting development projects? Cheryl, please go first.
Thank you, Esther, and delighted to be on the panel today. As we all know, we're all grappling with the effects, both long-term and short-term, of COVID, and obviously a great impact on GDP and a great impact on FDI, as we've seen across the continent. ABSA operating in the 12 markets that we do across Africa was, had to look and say, what is our plan going through the COVID crisis and through the pandemic. And we really took two approaches, which was protecting lives and protecting livelihoods. And so what we sought to do initially was to say, what is the medical support? How do we get involved medically in terms of PPE, in terms of really availing the countries in which we have a presence of support? And then most importantly, and the role as we play in a bank, and recognizing the importance of the social impact role that we play on the continent, was around protecting livelihoods. So really getting involved in terms of looking at giving support into the ecosystem, looking at giving debt relief on loans. We gave in excess of $500 million of relief to clients, and so really played a role. And I think that going forward we see significant opportunity, and I'm sure we'll unpack that later. But opportunity, although FDI is down at the moment, we see opportunity in the trade space, really ignited by the Africa Continental Free Trade Agreement, and that needs to be leveraged with the other infrastructural support and growth that we see a wide gap, but we see investment opportunity too. And we will surely be there to support those opportunities of development.
Well, great. David, you're up next.
Thank you, Esther, and thank you very much to MIGA for having me on the panel and for giving us the opportunity as Quesada to mention what we're doing on the continent, especially in this sector. We are focused on private equity real estate with a focus on hotels in Africa, hospitality. The platform was launched in 2019, so you can only imagine that a year like 2020, which is an historic year in terms of stress test in the sector, was enormous for our sector. So we see ourselves as solution providers in a sector that is already a large employer across Africa, and considering the loss of the closure of hotels, the loss of jobs on the continent, and the difficulty for government to support a lot of the workers in the private sector, like things that have happened in the US or Europe, we see ourselves as not only solution providers, but impactful investors. So what we've done during this difficult year of 2020 was basically readjust our approach to investing in the sector, continue to be counter-cyclical investors. It doesn't matter what time of the cycle we're in. We are long-term investors in Africa and in the sector. So we adjusted our strategy a little bit by focusing a bit less on greenfield investments and more so on acquiring hotels that are already existing, what we call brownfield investments. And it went from basically a shift in terms of investing to creating jobs to actually job preservation as far as Quesada was concerned. And we executed that, and we've acquired 10 hotels in the past 12 months. And we're basically bringing our support to that. And hopefully most of the viewers have seen the video before where we've been able to acquire hotels, and not only do we acquire them, but we continue to invest in them. So we're extremely bullish on Africa. We're very bullish on the sector that requires our capital, and we're here to help and we're here to support it. And we're very much long-term investors.
Fantastic, David. Dermot, let me bring you in here. From a bigger picture perspective, what is your assessment of what countries need to do to further drive investor interest? And what do investors and lenders need to get better at to take advantage of investment opportunities?
So first, I want to thank you very much. And I would really like to thank the Minister and Cheryl and David for those insights, because we learn a lot from them. I'll just make two short points, Esther. I guess the first one is a fairly obvious one, which is just as all African countries are not the same, all foreign direct investment, whether it's to Africa or to other parts of the world, is not the same, right? And one can think of FDI as consisting of three types. The first type is resource-seeking FDI. So these are investments that are for accessing Africa's natural resources, like minerals and metals, and Africa gets a lot of these investments because it has a lot of natural resources. The second is market-seeking FDI. And these are investments to access Africa's growing markets for goods and services. Now, Africa doesn't get a lot of these because its markets are neither big nor terribly well integrated. But they're getting bigger and they're getting more integrated, so these investments ought to grow. The third is what we call efficiency-seeking FDI, and this is the holy grail of FDI in a sense, because these are investments to access opportunities for cutting production costs by locating production in Africa. And these bring three things. It brings patient finance, it brings good jobs, and it brings socioeconomic progress. And this is what is related to global value chains, because most goods and services are not produced in one place any longer. They're produced in many places. And Africa ought to be a big part of this, but it isn't, right? So these are the three things, and they require different things. So I can tell you more about that, but basically, for the first type of investment, what Africa really requires, or what African countries really require, are good institutions. For the second type of investment, it requires good institutions, but it also requires good infrastructure. And for the third type of thing, it requires both those two things: good institutions, good infrastructure, but it also requires well-targeted interventions. And I'm sure that my colleague Ethiopius will actually tell you about some of those.
Very well said, Indermit. Ethiopians, let me bring you in here. Now, MIGA's role is to drive FDI to developing countries, and Africa is a priority region. What is your reflection on how things have gone over the past one and a half years?
So thank you, Esther. And as the Honorable Minister indicated, the COVID-19 pandemic has led to rising debt burdens as governments try to combat the economic impacts, mostly through prolonged lockdowns that disrupted normal economic activity. And in Africa in particular, we've also seen a dramatic decrease in trade finance available to businesses and governments, which in turn has significantly constrained imports of critical consumer, corporate, and medical goods and services. But despite the impact of COVID, we've had some interesting and innovative projects over the course of 18 months, including our first support to an off-grid power project, our first support to commercial and industrial users of telecoms, our first solar IPP in Burkina Faso, our first geothermal IPP in Ethiopia, the first IPP project for roads in Kenya, and first support for a continent-wide hotel asset acquisition platform, and you heard from David on this. But we've also witnessed a number of trends which I think are worth highlighting. We've seen an uptick in brownfield asset acquisition plays across the tourism, power, telecommunication, and mobile money sectors. Large-scale infrastructure projects are being delayed or stalled as governments focus on economic recovery efforts and corresponding fiscal pressures. We're seeing a shift from publicly funded projects to consideration of PPP structures, but with governments very carefully scrutinizing their potential liability. We're seeing increased focus on water, telecoms, and digital infrastructure. A slowdown of FDI as investors focus on building resilience in their current pipeline of projects. We see governments considering negotiation of existing contracts, renegotiation of existing contracts, particularly in fossil fuel IPPs. And then a shift towards distributed energy solutions, off-grid, mini-grid, metro-grid, and CNI solutions that don't rely on public sector offtake, but on a sustainable enabling environment for investments over the long term. And finally, we see continued interest in renewable energy IPPs in new African markets, as highlighted with the Burkina Faso project I mentioned earlier, as well as a focus on decarbonization of fossil fuel-based projects.
Well, thank you so much, Ethiopians. You make some very good points there. Before I circle back to Minister Hutt, just to tell our audience that we do apologize for the audio issues that we've had. We're aware of them, we're fixing them, and we thank you for your patience. Now, circling back to Minister Hutt, let's talk about solutions. What is Senegal doing now to keep FDI flowing to the country, and what lessons can other countries and on the continent take away?
Thank you very much. I mean, we've been actually mainly really focusing on reforms on one side, but also on another side, really developing what we call the agropoles and spatial economic zones in the country. On the reform side, we've been focused on several areas. Number one is the Compact with Africa reform with the German government, with the G20 initiative, focusing on four key areas to attract more FDIs, to facilitate the business environment. Number one, it is to focus on access to land for SMEs, access to finance, but also reforming the labor laws and the labor administration process as well, so that it's more friendly. And lastly, focusing also on human capital, basically on vocational training. So we have more young people being able to address the needs of investors. And the other type of reforms, with the main one really that have been keeping us busy during the COVID time, was the reforms on the PPP framework. We had a very, let's say, complex framework. We definitely actually simplify the process, making sure that the process is very clear, very flexible, very diligent, so that we don't waste time. And during that reform, we also decided to create a project preparation facility so we can prepare projects for the private sector in various sectors in the social sectors, including the healthcare sector, but also on the economic infrastructure, so that we borrow less and we help the private sector invest more alongside the government, with the government providing the facilitation and sometimes some guarantees. And I'm sure some of those PPP projects will need at the right time MIGA guarantees, because sometimes we have undertakings of the government vis-a-vis the private sector. And if MIGA can cover and strengthen those undertakings, that will facilitate the investment of the private sector. And on the special economic zones, we are fast-tracking the construction of some of those. For the agropoles also, we are fast-tracking the construction of those, so that we can add value to our local production. We produce, let's say, a lot of peanuts, we produce a lot of cashew nuts and mangoes that are being destroyed because we cannot consume everything fresh. So we are trying to have those facilities, areas, those agropoles, so that investors can set up their own enterprises and industries and transform locally, add some value before exporting. And I believe that one of the key lessons is really to have a simplified PPP framework, but also to have a project preparation facility, because otherwise you will not have investors. We used to rely on external project preparation facilities, but sometimes it takes time. And now we decided to have it in-house, and we will contribute our own money next to the investors to prepare projects together. Sometimes we prepare it alone and then hand over to the private sector, who can then invest their own money.
Thank you so much, Honorable Minister, for that. I'm sure the private sector will be very happy to, just listening to those words. David, let me bring you in here. What is your prognosis of FDI trends in the region going forward, and what kinds of opportunities are you looking into?
I think we're pretty big believers that FDIs will, some of the countries that have had a dip on it will rebound in the next few years. I think if you look at GDP growth in Africa and what happened in 2020 and the rebound that we're seeing in some of these economies, Africa at the end of the day ends up being quite a bit of a resilient economy in general, and quite diversified in its different makeup. So we're long-term believers in that. The only thing that we change is, as the cycles advance and change, we just adjust the way we invest, as I mentioned earlier. So I think what we're looking at now in the next 12 to 24 months is to continue to invest in the hospitality sector. We're investing close to $1 billion, right? We've already started our investment program. We've been investing close to $1 billion in the hospitality sector that is heavily fragmented and on the downside. We will look at more greenfield projects effectively as well. We still want to focus on that, as we still want to have that part of our portfolio. So we will be looking at a few key ones and hopefully announcing them in a few months. So on the greenfield, that's one case. On the brownfield, we'll continue to do that, because the pain that the hospitality sector has suffered over COVID is not necessarily going to be something that hotel groups and hotels will come out within the next few months. It's going to be a long way out of that. So we'll remain solution providers. So that's one key thing. And aside from these solutions, I think it's great to also have the minister on the panel. Is we also want to oftentimes work with government effectively, because we're one of the few investors who in the middle of this crisis are going into countries trying to invest, support jobs and create jobs, right? So the more we have discussions with government, the more we can see good ways to work together, create value. We have MIGA that as also guarantors in some from providing insurance products. We have the IFC funding us as well on the senior debt. So we're bringing together all the different support groups that can happen, but the government is extremely important in terms of attracting private investors who can come in and do that. So I think for us we don't really have specific region. We're investors across sub-Saharan Africa. We'll continue our program. And but most importantly, post-acquisition, our view is continue to spend money to reposition assets in good quality international standards across Africa. So then when you fly in from Paris, London, and New York into hotels in Africa, the standards are maintained, but the culture, the African culture, the culture of the country comes out in the asset as well. So we will continue doing our investment program with a few tweaks here and there, and ideally with the support of governments as well.
Well, David, you said it, I mean, well said, especially on the point with governments and the private sector. Outcomes are always better when there is a better handshake between the government and the private sector. Cheryl, let me bring you in here. What do you think the opportunities are for investments between countries on the continent? And are you just as optimistic as David?
Yes, I believe we are. And I really think underpinning some of that is the key milestone which was achieved this year, and that was the implementation and the execution of the Africa Continental Free Trade Agreement, as I mentioned earlier. You know, during a time where the economies have been really hard hit by the pandemic, it really does offer some economic promise and really offers the potential to stimulate recovery out of the pandemic, and also offers new opportunities between Africa to Africa trade, which is really needed. You know, the World Bank is looking at the Continental Free Trade Agreement to uplift in excess of 68 million people out of poverty. So this is a substantial number. That being said, as successful as the free trade agreement will be, or the area will be, it's hugely dependent on consistent infrastructural development and growth. And as Ms. Gill mentioned, you know, there are significant gaps. There's significant FDI interest in the infrastructure space, but there's about $100 billion per annum of infrastructure investment required. And so although in some instances we've seen that this has been slow, however, we're starting to see some projects that are taking shape. Renewable energy projects, other power supply. We know that Africa has a need for energy, which will then stimulate other sectors. We're seeing other infrastructural developments in roads, rail, port. So we're seeing these developmental nodes pop up, and importantly tagged to that, which I think goes well with the goods and services FDI required, is obviously digital. And I think that digital will continue to play a key role in the development and in infrastructural development. So really, I think what we're seeing is that economic growth, development, and success are really linked to infrastructural development, and that'll result in positive return for investors. But I think also key to the success is the link up and the partnerships that we see come about in public-private partnerships. These are key critical, and I don't believe that there's one institution or one government that will be able to do it themselves. And so it really will be about a collaborative effort between commercial banks, between public sector, between private sector, and of course, importantly, with development financial institutions. You know, we're proud to have a close collaboration with MIGA. Earlier in the year, MIGA announced the support to ABSA and the issuance of guarantees nearly up to the tune of $500 million for ABSA. And these guarantees are valid for as long as 15 years and really allows ABSA to have the relief to on-lend into the SME sector. This is also key critical to the continued development and the sustainable growth of Africa.
Well, thank you so much for that, Cheryl. Ethiopians, let me circle back to you. Now, world leaders are talking about economic recovery that is intertwined with a sustainable climate-focused recovery. Now, how do MIGA products encourage foreign investors to invest in climate-related projects in Africa?
Thank you, Esther. So guarantees are becoming the instrument of choice for many in the private sector looking to invest in climate projects in Africa. And as a result, we at MIGA have been able to catalyze private sector finance for climate projects, and we've delivered over $1.6 billion in guarantees in support of climate finance transactions in sub-Saharan Africa since we started tracking climate transactions in our fiscal year 16. Now, the bulk of MIGA-supported climate finance projects during that period have supported the development of cross-border renewable energy projects in solar and wind and hydro. However, we also covered projects that help to green the region's financial institutions that support energy efficiency and climate-smart agriculture. Now, increasingly, working very closely with our clients, we're focusing our support to enhance the climate resilience of our projects, and this is particularly important given the region's vulnerability to climate change. And we're now marrying our expertise in financial structuring and management of ESG and other risks that help mitigate the perception of risk in investing in Africa with our expertise in climate mitigation and adaptation. And this creates new opportunities for climate business. And I'll mention three areas we're working on taking this approach. First, we're looking to attract foreign investors into expanding their presence in renewable off-grid and metro grid energy, which can help underserved households gain access to clean energy. Second, we're working with our World Bank colleagues and bilateral partners and exploring how foreign investment can support decommissioning of coal-fired power plants and a transition to green energy, with MIGA potentially providing guarantees against government commitments in that process. And finally, using guarantees, we believe we can help de-risk and scale up the region's role in carbon markets, given its abundance of natural capital that can serve as a basis for carbon credits. So we think working with the public and private sector, we're quite optimistic that we can, taking this approach, continue to mobilize foreign investment into climate opportunities and support both of mitigation and adaptation that will serve the development objectives of the continent.
Well, thank you so much, Ethiopia's. Dermot, let me bring you in here. I believe this will be my last question to my panelists. Just a quick word to our audience that we will take about 3 questions. Thank you so much for sending in your questions. We see your tweets, we see your retweets. Thank you also for using the hashtag. So we'll come and take about 3 questions from our audience after this. So Dermot, let me just ask you this last question. What other policies can governments adapt that would further help catalyze FDI in Africa, particularly in transformative sectors that foster greater equity and economic growth?
Excellent question, Esther, and a very difficult question. But just as I talked about 3 types of FDI earlier, I want to emphasize 2 aspects of this FDI. The first one is quantity, which helps the economy grow. But the second one is quality, which makes sure that the average African citizen actually benefits from this growth. And I think that if one looks at these 3 types of FDI, you actually find that you have slightly different priorities in terms of quality and quantity. So for example, for resource-seeking FDI, I'd say that the top priority is quality, right? We want to be sure that the FDI actually benefits the owners of these natural resources, the ordinary people, right? So for example, the deals made by foreign investors in, say, oil in Chad or copper in Zambia should be transparent and fair. And that means that the folks who are bringing the money should earn a fair return, but the government should get revenues and the people should get the benefits of these revenues. And I think that the institution, the highest priorities are resource sector governance and public financial management. Now, for market-seeking FDI, the issue, I think the big issue along the lines of what Cheryl said, has to do with integration. Basically, and this is because Africa is fragmented into many small markets, much as how Europe was 30, 40 years ago. But Africa, if it were just one economy, it would be $3.5 trillion, right? But the problem is that Africa has a lot of small economies. So you have to integrate these markets, and the ACFTA will definitely help, right, in this one. But this is very difficult business, and one has to be patient because even the European single market has a lot of unfinished business, especially in the market for services, right? So one has to be patient with this one. And the third part, the part which is going to be the hardest, is the efficiency-seeking FDI. And here you want both quality and quantity. And this is a massive agenda, Esther. And basically any developing economy, has to get help from organizations like the African Development Bank, the World Bank, the IFC, and of course, MIGA, because this means that you have to take big risks when you're bringing in FDI of this sort. And because this means locating a part of your production that is part of a larger global value chain in a poor country. So political stability starts to matter, infrastructure quality starts to matter, all of these things. And you have to get this mix right. You can't rely just on fiscal incentives, just on special economic zones and so on. Those will be important, but you need all of these other things along the lines of what the panelists have said. I'll stop there.
Thank you so much, Dermot, and also a big thank you to all our panelists for today, sharing those very insightful comments and, of course, into foreign direct investment on the continent, how the private sector can have a better handshake with government, and, of course, surmounting all the challenges, particularly in this post-COVID world that we're all living in. Thank you so much for your time today on the panel. Also, thank you to our audience. Just to quickly mention that we know we're running slightly over time, but we just want to quickly accommodate some of our audience questions. I'll just quickly take one, and perhaps I'll just choose one of the panelists to answer the question. I'll start with this question. Perhaps Honorable Minister Hott can answer this question for us. It says, how can FDI accelerate the growth of the Africa Continental Free Trade Agreement? I know that is already in effect. It's a continent of 1.2 billion people, potential GDP of 2.5 trillion US dollars. Minister Hott, what are your comments on this?
Yeah, it's a great question, and we definitely need more FDIs towards Africa, or intra-African FDIs, basically, so that we can produce more in Africa and sell within Africa, because otherwise the continental free trade area will just provide the opportunity for people investing outside the continent and producing outside the continent to just export massively into our continent by going through, let's say, some countries to reach the whole continent. This continental free trade area will be quite interesting if the investment is happening inside Africa, the value added is happening inside Africa, and then exporting to other African countries from one African country, let's say. And I think our governments have to really fast track all the reforms to make the business environment friendlier, so that people can say, let me go to Africa, produce there, sell into Africa, instead of producing outside the continent and then export into our continent.
Yeah, thank you so much, Honorable Minister, for that. Now, this next question, I think I'm going to pose this question to Theopis. It says, are there any criteria that make a country more favorable and open to foreign direct investment? Mr. Tafara, if you could answer that.
I started by saying certainly, Esther. There are conditions that make for a more favorable setting for foreign direct investment. I mean, it obviously depends on the sector, but the regulations around a given sector's activities frequently will determine the comfort and the appetite that foreign direct investors have for pursuing a project or an investment in that particular country. So it very much depends on the sector, but certainly the ability to get your money out is a critical factor. The ease with which you can get services and products that you need for a particular project or investment is also a factor. There are a number of factors, but yeah, I think you'll have to look at the particular sector in which you're interested to develop as a government, as a country, and determine what you may need to ease in terms of regulation, or what you may need to change in terms of regulation to actually facilitate the investment that you're seeking. And it will be very sector specific. But investors usually have a bottom line, frequently have shareholders, and they have criteria that they meet. So taking those into account, you can determine what you may need to do to make it easier for direct investors to consider your market.
Very well said. Cheryl, perhaps I can ask you this. We're just going to take this last question. What criteria should businesses and entrepreneurs meet, or tips to keep in mind when an opportunity such as FDI is presented to them?
I think that one of the biggest things is around long-term appetite. So that Africa can be quite cyclical. So if an investor is looking at coming into Africa with a short-term investment attitude, I don't think that that's the right continent for investment. I think that Africa is one that will offer great return. It offers great opportunity, but the investment and the real commitment has to be there. It has to be long-term in nature, and it has to have the ability and the sustainability to handle the waves that may come. We've seen how vast, how economically hit Africa's been through the COVID pandemic. And so you need to know that you have the ability to ride the waves when they're ups and then when they're downs. And your investment policy needs to be one that keeps the capital in there for the long term. And there will surely be a return and success on it, but it's around the investment appetite for on a sustainable basis.
Well, thank you so much, Cheryl. Now, I mean, we have a plethora of questions that our audience have sent in, and I'm quite thrilled to, I mean, just the interest and, of course, the enthusiasm on the part of the audience sending in all these questions via different online platforms, showing, of course, and how very much interested you all are on this particular topic. But I'm afraid that's where we're going to have to leave it with the questions. But of course, like I said earlier, this is just the first in an annual series. The conversations will continue, so you can continue to engage on the platforms, on the MIGA platform, social media handles. Of course, continue to engage MIGA on this particular topic. Well, you have been watching a live event hosted by the World Bank's Multilateral Investment Guarantee Agency, MIGA. I'm Esther Awoni. I've been your host and your MC.